Today, I want to share with you my favorite way of finding dividend stocks and numbers and metrics that I look before investing into a specific dividend stock. Just like most people, when they're starting off the first time buying stocks or dividend stocks, you kind of follow what other people are doing online. I watch YouTube videos and I kept on hearing the same stocks being mentioned. So for me, that was intriguing. I looked at it and started buying them. But honestly, I was just following what other people said and I wanted to take it more serious and get a better understanding of how stocks are being selected and why I should make a selection on a specific company. And that's when I started digging deeper into what's important for me. It always matters what is important for you as an investor. Different investors have different priorities when they invest into things. Some people invest for growth, so you look at other metrics. Some people invest in dividend growth stocks like I do myself, and we look at other things there as well. There's no right or wrong. I do think there are a few key metrics that should always be relevant, things like profitability. If a company is not profitable long term, I doubt they're going to be sustainable. If of course you do day trading, maybe it's not so relevant for you. So there's always different factors to consider, but in this video I want to focus on things that a dividend growth investor should ideally focus on. And for me, that always starts off by looking at the stock screener. There are a lot of websites out there that have free stock screeners, but one I like very much is from Dividend Watch, which is also the tool I use to track dividend income, etc. But there's also another great one I'll show you in a second on Seeking Alpha. So these are the two platforms I use the most. And once you're logged in over here, you can obviously navigate to explore stocks on the top right here. And from here, you can put a couple of filters, which I think are very relevant. So first off, it starts with selecting your dividend yield. How much yield you want to get from a particular investment. Obviously, some of the tech stocks and growth stocks, they have a much lower yield because they're reinvesting a lot of the income into growth. On the other extreme, I see a lot of people getting sucked into chasing dividend yield. For me, anything over 6% kind of rings warning signs because I don't think it's really sustainable for the long term. And often there's a reason why they're paying such a high yield. But again, that's something where you have to do your homework, where you feel comfortable with. For me, usually what I look for is anything from 2 to 5.5%. That's kind of my range I usually put over there. Then for me, very important is the dividend growth because I want to see growth over time, right? Because it's great to get a dividend, but if it's not growing, it's not really so interesting for me. And that's where the compounding comes in over time. So for me, that's very important. I want to see here 5% minimum. Then in terms of sectors, if you have any preferences, you can select it over here, but I don't have that. In terms of stock type, you can also choose, do you want an ETF, a REIT, which is a real estate investment trust, or just a stock? In this case, let's look for a stock and a REIT. Market cap, I think that's also very relevant because I personally don't want to invest into a very small cap, which basically has a market valuation of less than 10 billion. I know it's a large number, but the larger it is, the less chance it will fluctuate very much or disappear overnight because these huge companies, they usually tend to be more stable and obviously have a longer operating track record, so to say. So for me, I usually select large or of course mega caps. Payment frequency of the dividend itself, for me personally, I would prefer a quarterly, ideally even monthly. Most dividend stocks usually tend to pay on a quarterly basis. Of course, the European ones, they do pay on a biannual basis or even on an annual basis. Ultimately, if you look at the whole year, it really doesn't make a difference if you slice it up into monthly, quarterly, or annual payments. But I think it's just nicer to see that regular income coming into your account on a more frequent basis. So that's usually what I look for, but it's really up to you and your preference. Then you can also select over here the exchanges. Do you want to invest in New York Stock Exchange? Most likely in my case I do because I want to buy mostly US-based stocks, but you can also select London Stock Exchange or German stock exchanges. Wherever you're based, you can definitely go through here and select any stocks that are listed outside of the US, for example. Then we have volatility. That's for me not something really too relevant because usually the stocks with such mega caps, they don't fluctuate that much. So I usually leave that empty. And then of course there's also a dividend rating score. But in my case, I do my own due diligence, so I don't grade that. So then I click on search over here and boom, here we are. It found me 228 dividend stocks that I could choose from. Obviously quite an extensive list. What I do usually then, I sort it by dividend yield. So just to see kind of what is attractive yield right now. And you can see immediately some of the higher paying ones that are usually companies you haven't heard of. And only when I scroll down over here, I see the first one that has a big name, which is Blackstone, which is currently actually trading at a very high percentage. And then scrolling down further here, I can see Realty Income, very nice yield of 4.8%. And from there, you can definitely see some more of the more established names, etc. So from there, you can actually go through and really analyze and have a quick snapshot overview of what catches your eye. And if it does, usually what I do, click over here into my favorite, and that goes into my watch list. And later on, I can do more analysis on it. But basically, you will see the price over here. And for me, the price really means nothing anymore, especially when we live in a world of fractional trading. Even if the stock costs $100,000 for one share, obviously I'm not going to buy an entire share, right? I can even buy a fraction for $10 of that share. So I think prices, people get too hung up on price. It's really just a number. Obviously you want the number to go up after you invested, but other than that, it's really not meaningful indicator for me. Then we have the PE value, the price per earnings. And for me, that's a good indicator. It's kind of the multiplier of the earnings to the price. So that gives you an indication. For example, if you buy for right now Blackstone, the price would essentially be 35 times the earnings. So it's quite high. Usually I like to look for something 20 or 25 PE, but obviously it also depends on the industry, etc. But it's a good indication of how highly valued the company is. Then of course the dividend yield, which is great, but it's not the full story. I'll show you in a second more why it's only a part of the story. And of course, the payout ratio, which is also very important. It's basically how much of the net income the company uses to pay the dividend. If, for example, they pay 100%, that means everything they've earned, basically they pay out to shareholders in the form of dividends. Because actually it means they don't have too much money to reinvest and grow the business in the long term. So I think it's very important to look at this number. Ideally, again, I want something between 30 to 60%. That's kind of healthy. Anything over, it's really unusual. Unless it's a REIT, you can see over here, for example, realty income is 210%. I know these percentages look a little bit weird, but there's certain laws and rules behind it why it is so high. It's actually stipulated that they have to pay out at least 90%, and then obviously they do certain adjustments to the numbers, depreciation, etc. So it's a little bit not so straightforward, but for most other companies you see over here, ideally you want the number to be in the green. Anywhere below 60% I think is quite healthy. That allows them to reinvest some of the profits into growing the business. And then over here I have the dividend growth over the last 3 years. Usually I prefer looking at over the last 5 years because 3 years is a bit short. I'll show you in a second in Seeking Alpha where you can find that. But that's a good indicator how the companies are growing. Anything that doesn't have a growth for me immediately is out, because if I see a company that cut dividends a certain year, for me is a huge red flag because I'm in it for the long term. And if they cut it 1 year, they might do it again. And having a dividend cut is like a salary cut basically. You don't want this to happen, right? So you want to really make sure that they grow it consistently over time. On the other hand, of course, if they grow it by 100% within 3 years, there's also something fishy. It just doesn't seem normal. That means they paid out too aggressively, and for me, there might be risk of that not being sustainable. So I think that's also important. And lastly, that's a dividend score that's calculated from the website. Different websites have different measures of calculating it, but it's a good indication. Obviously, you want the number to be green, showing that obviously considering a lot of factors, overall they see long-term growth and good dividend income for that particular stock. So hopping over to Seeking Alpha, you have the same over here on the stock screener when you click over there, and then obviously you can do your own filters. So I already have one set up, US and Germany dividend growth. You can label it what you want, and you can see over here obviously what I put. In terms of company details, I look for stocks in Germany and United States. Over here, once again, I select the market cap, anything over 10 billion. If you wanted to choose different ratings, you could do that as well, but I usually don't look at it. Then on the dividend side, I select 2.4 to 6.4. Dividend growth for 5 years, as I said before, for me that's very important. And I selected over here 6.5% all the way to 20%. And then years of growth, also very important. How many years in a row they have been growing? And I've put anywhere from 8 years, because if it's just 2-3 years, it's too short of a period for me. And then obviously consecutive years, similar concept over there as well, from 80 years. Because a dividend king company, for example, like Coca-Cola, they've been growing the dividends consistently for over 50 years. So that's really amazing. But obviously there's only a handful of such companies out there. So I kind of lowered the bar a little bit to only 8 years of growth. And then you obviously get all the companies that qualify that over here. And once again, you can sort, if you wanted to by dividend yield, and then you can quickly see here what's happening, what are the companies, and then kind of drill into each of them. So if I found a company that I really liked, I would obviously go into that and then add it to my watch list. As you can see over here, I have my Interactive Brokers account, which I'm using, and is linked directly to my Interactive Brokers portfolio. And then I have a watch list of stocks that I'm watching and might potentially buy in the near future. And here I have a really good snapshot overview of what's happening, all the data. I have customized my view how I want it. So I really see everything I need for a particular stock to make a decision to buy or not to buy. Also something I always look at is the 52-week range. And when I see a company I already did my homework on and I'm excited about, and it's reaching a 52-week low, meaning the lowest price has been for the last year, that would really get me excited to buy that particular stock, because I don't want to buy a company that actually has the highest price currently, because I have so many others to choose from. If they reached the lowest price within the year, then definitely that would be my pick for the particular day when I want to buy that stock. So that's really my process of finding and identifying dividend stock companies that potentially I would be interested in investing in. Obviously, you have to find your own parameters. Do you want more growth? Then maybe you want to lower your dividend yield percentage. Do you want to be even more conservative? Then maybe you want to increase the consecutive payout to 20 years, let's say, right? Increase it. So it's really up to you. You have to find what is relevant for you. And the longer you start investing and looking at companies, you get a better idea of what's important for you. I think I'm kind of a hybrid in a way. I'm quite traditional in many ways, I want established companies. For me, finding the latest new hot stock, for me, it's just too risky. I invested in Palantir, Peloton, DocuSign, all these companies that had huge growth, but then in the end went really nowhere. So now I'm really sure that I want to invest into companies with long-term growth potential and that have a consistent dividend payout history. And then before buying a stock, obviously, I do my homework and a bit more due diligence and kind of drilled in. In this example, let's take Starbucks to kind of do a bit more analysis and show you the numbers that I'm looking for. At first, obviously, I look at the overall price development, click at the 10-year and see, okay, over 10 years, Starbucks has been growing nicely by 258%. And in total, since its inception, which was back in 1993, it has been growing by 17,300%. So a very nice return indeed. Then to the right of the chart over here, I usually look at a couple of things. EPS for me is really not so interesting, honestly, and there's a lot of reasons why it's not that relevant. I know some investors love it, but for me personally, I mean, I look at it, but it's not really something I base my decision on. There's a lot of ways that can impact EPS, such as buybacks, mergers and acquisitions of the company, etc. And you can really, with a lot of financial tricks, tweak that number. In fact, I actually found an article that really said why EPS may not be the best figure to look at. There's a lot of reasons why this number can be misleading. It's still a good indicator because there's not only one indicator. You should always look at the big picture, but for me, it's not the most relevant number. I prefer actually the PE ratio because it kind of gives me a value of how much I'm paying for that particular company share, how much is worth, how much is priced, what is the multiplier I pay on that company. So 31 actually is on the higher side for technically a coffee beverage company, right? The dividend yield over here at 2%, that's forward yield. So that's for the anticipated coming 12 months. There's also the trailing dividend. So that's for the past 12 months. So usually these numbers are slightly different, but more or less in the same range. And something interesting always to look at is the short interest. You don't want this number to be too high. Anything over 2% means that a lot of people are actually betting against the company and hoping for the company to go down in price because that's when they make their money. So yeah, for me, it's always important to kind of have a lower number, meaning more people bet on the company increasing in price, which is the same that I do, obviously. Then, of course, the market cap is a good indication in general. How valuable is the company? Right now, we know Apple, still the most valuable company in the world, is priced around 2.2 trillion. So, that kind of puts things into perspective. Starbucks was priced at 1 trillion. How much it can potentially still grow? Because if it would double, it would already be the most valuable company in the world. So for me, it's a good indicator. Then they have so many other articles and numbers and ratings over here. I have the premium plan on Seeking Alpha, so I get even more insights that you don't have on the free plan. But really, I mean, so many things to go through. So for example, on the ratings over here, I don't place too much importance on the ratings because obviously people are always biased, right? They have 3 different ones, which is nice. The quant rating, which is kind of the computer algorithm that comes up with a certain rating and gives you an indication. Obviously, ideally, the more green you have, the better it is. If there's red, then it might be something for you to do more due diligence. For example, the valuation, they say it's overvalued, so something to look into. Then they have their own Seeking Alpha analyst ratings, and they give an indication of how the stock is going, etc. And lastly, you have Wall Street's analyst recommendations. So once again, kind of seeing the general consensus of analysts on Wall Street. But analysts, I always think if they knew it all, they would do the right decisions themselves and probably start their own fund if they were the geniuses. But then again, you kind of crowdsource a lot of different opinions and have a kind of tendency. If everybody says the stock is going down, it might be a reason concern. It doesn't mean it will happen, but it gives you an indication. In this case, obviously, you see the average consensus is a 6.3% upside, different price points, etc. So, but I'm a long-term investor and nobody can predict what the stock is going to do in 10, 15, 20 years. So for me, it's nice to look at, but it's not really fundamentally important for me to make an investment decision. I think the financial is very important and you can really get lost into here because they really have so much details here and you can really drill down the more you want. But of course, most importantly for me, I always look at the total revenues. I want to see those numbers ideally grow over time because if you don't have growth in revenues, that's usually a sign of declining business because most declining business will start having declining revenues. That's the most important part. And then of course, you can look at all the other costs, etc. But ultimately you want the net income to grow as well. And as we can see over here, there was a year when it didn't grow. Then I would go read the report, try to understand why it dropped. I mean, there can be so many different reasons and it's so easy to financially manipulate certain reports in a way how you see fit. There's adjusted earnings, etc. But it's a good indication to look at it. But once again, it may not be alone enough for me to invest or not invest. Of course, some people like to also look into the balance sheet, which I think, if you really have a better financial understanding is good to do, where you look at the assets of a company and the liabilities. But once again, that's really up to you how much you want to spend on that. And lastly, of course, cash flow, because ultimately cash is king. So for me, I really want to see cash from operations, ideally also growing over time. Here, it looks a little bit questionable. So that's something, once again, I would drill a little bit deeper. And then we come to one of my favorite points, which is dividend dividends. Obviously, that's why I'm investing in a company, is for the dividend and dividend growth. So when we look at dividend scorecard, you can see over here a quick dividend summary. You can see here the yield, you can see the actual payout amount, and of course the payout ratio. So once again, for me, 68% seems fairly healthy. And here is the 5-year growth rate. So for the last 5 years on average, they have been growing the dividend for 13.15%. So imagine that's like getting for yourself every year a 13% salary increase if you see dividends like your income in the future, one day that you don't work anymore. So getting a 13% salary increase every year, I mean, that's pretty amazing if you ask me. And the dividend growth has been happening for the last 12 years, which is also good to see. In my previous filter, I had 8 years, so that's already ticked the box over there. And you can see over here, they pay on a quarterly basis, and that's the next payout date coming up over there. Then I like to look at the dividend yield as well, which is good to see. Once again, let's select 10 years, and you see here how the dividend yield has been changing over time. And obviously that also depends on the price. If the price grows faster than the actual dividend payout, your yield naturally goes out and vice versa. So it's a good indicator, and just to see, how has the yield been developing, and obviously looking at the past, and currently the 2% is actually not too bad because many times has been below 2%. The yield on cost is also very interesting. Technically it won't make a difference to investing, but it just shows you the earlier you bought, the higher you yield, because basically the price at the share was much lower versus how much you're being paid out. You might have bought Starbucks a while back when it was $10, and today you're getting $2 dividend. So that equates to 20% dividend yield on cost, right? So that's really good to see. It just shows once again, the longer you invested, the higher your dividend, if they're growing, the yield on cost will be. And lastly, what I always look at is the dividend growth, because again, I'm a dividend growth investor. I'm not just chasing yield right now, but I want to see the dividend growing over time. So when I select 10 years, I can really see how it's nicely been growing over a year. You can see back in 2013, you would have received for one share only 45 cents, while today, or in 2020, you are getting $2. So that's a massive growth, and that's really exciting because once again, that allows you to compound the growth over time. That's how Warren Buffett became one of the richest men in the world, by having that snowball effect, reinvesting your dividends and letting them grow over time. And one more thing I always like to look at is momentum, which basically benchmarks your chosen stock versus the S&P 500, which I call the market or the golden standard you want to compare yourself against. So when I look at the period of 10 years, I can see here the S&P 500 grew by 158%, while Starbucks actually outperformed the market by 257%. So that's really quite a difference. You can see here, really nice development over time. But even more so if you consider the total return, because this one is the price returns. That's basically only comparing the price of the stocks. Here we consider reinvested dividends as well, and you can see that really made a difference in itself, because now instead of growing by 257%, Starbucks actually grew by 327% just by reinvesting your dividends. So that really shows you what a difference it makes. So yeah, there you have it, price return versus total return. In total 327, if it's only the price 257, and that's really important because I want to look at the total also. There's no point for me getting 5-6% yield if the total return actually drops because the price is tanks, and that's the issue I have with a lot of people seeking high dividends. Sometimes you get 10%, which is great, but the total price of the company drops. So technically you're losing in value, even though you're getting it paid out, but on a much lower principle. So I think it's important to look at the total return of your investment. And that's actually all I look at the numbers. Obviously, it's always nice to see analysis and read reports and see the news. But once again, these things are short term and can change, year by year. So it's relevant. I obviously look at these things in the companies I'm invested in. If I see a big red flag coming up, obviously that would impact my decision making. But as I said, I want to invest into companies that have a long-term potential that I could still see in 5, 10, 15, 20 years operating. I don't know which AI company will be the prevailing one in 15 years, but I know that people still going to be drinking some kind of coffee, some kind of beverage. That's why I invest into beverage companies. I know that people will still get sick and they're going to be needing some kind of medicine. That's why I invest into pharma companies. I don't see them going away anytime soon. So yes, in many ways I'm more conservative, but this way I'm very clear on my investing thesis, and I don't have to, jump in between investments and sometimes go here, then there and chase the latest trends. I think that's usually a recipe for disaster and also lower returns over time. One more thing I do like to do from time to time is go onto Dataroma, where you actually can see super investors, people like Warren Buffett, etc., what stocks they are buying and holding in the portfolio. You can search for the company over here. In this case, obviously, let's have once again Starbucks, and I can see, who owns Starbucks in the portfolio. A couple of big investment companies, for example, Jensen Investment, haven't heard about them, but they have 3.55% of their portfolio in Starbucks, which is pretty big. And moreover, they've actually recently added even more. But then again, I see a lot of others actually selling a lot of their shares. You can see here, Poland Capital Management reduced by 99%. 30%, another one reduced by 77%. So if these big super investors are dropping out all of a sudden, maybe that's something for me to be concerned about and do more of my own due diligence as to why they all of a sudden start selling the stock. And lastly, what I really recommend you is go to the website called quarter.com. It's free of charge and you can listen to their last earnings call recordings, which is really cool. You get to listen to the CEO, management board members, free of charge. They present the results. There's a Q&A sections where they answer callers' questions about the company, the performance over the last 3 months. They also have a great app where you can open the slides to it, see the report. So it's really, really cool. You can listen on twice the speed, which I usually tend to do. But this way you can really connect to a company on a much deeper level because all these numbers are all nice and great. But ultimately it's the people that run the business, right? And for me, that's very important also to invest into the people. Yes, I don't know if a CEO is still going to be there in 10, 15, 20 years, but the current team, for me, it's quite important to understand their vision. And by hearing it from the horse's mouth, so to say, while they talk on the call, I can definitely much more connect with them. While at the same time, I also had companies that I wanted to invest in. I heard the call, and honestly, after hearing management speak, I was actually really apprehensive to invest, and in the end, didn't invest in them because I just couldn't align with their vision and the way they articulated themselves. In the case of Starbucks, obviously they have the legendary CEO, Howard Schultz, who also founded the company. He's actually sadly stepping down as CEO. This was his last earnings call. It was so great to hear from him. And right now, for me, it's a big red flag because I don't know the new CEO. He comes from PepsiCo, so quite a promising future. But obviously, that's why I think a lot of investors get cold feet and selling their shares because they don't know where things are going. They obviously still have to deal with unions coming up, etc. So there are actually quite a few question marks about this particular company coming up. So myself, actually, I'm not going to invest into Starbucks right now. I still keep it on my watch list. I see how the price is going. If the yield continues to grow a little bit more, I might be interested because long term, I do think they have a strong future. But listening to the call, actually, I found out how much their reliance is on China. The CEO must have mentioned China at least 20 times in the call and the importance. Obviously, it's a huge market, but it also means for me, if the conflict with China and US is worsening, they might potentially say, we don't want to have any US companies operating in China anymore. And all of a sudden, they're losing a huge chunk of revenue. And for me, it's just a little bit too risky. And they're quite limited in their offering. Obviously, they have great stores. And I love the brand itself. Maybe not the coffee so much, but the brand experience is great. I would love to own Starbucks. But right now, I have a little bit too many question marks for a little return and yield that I'm getting. If I would be getting 4 or 5%, it might sway me over. But for such a low yield, I have too many question marks, and that's why at the time being, I'm not investing into Starbucks. I hope this helped you understand my thinking process and better guide you a way to find dividend stocks that appeal to you and your risk tolerance as an investor. If you do have any other questions, pop them in the comments below. I answer to every single one of you. And in this video over here, I'm going to show you how I actually track all my dividend income. If you enjoyed the video, please give it a like, subscribe to the channel. It means the world to me. Stay healthy, get wealthy, and I'll see you in the next one. Ciao.